Hello, everyone, and welcome to this episode of Junior Economic Club of Canada Interviews. We are a federally registered nonprofit organization led by students committed to promoting learning and interest in the field of economics, business, and finance. Among our various initiatives and activities, we seek to have interviews with expert industry professionals who are so kind enough to share their invaluable knowledge and experiences to us youthful aspiring economists. My name is Andrew Wu, National Director of the Junior Economists, and I will be your host for today's episode. Today, I have the great honor and pleasure to be joined by Jennifer Lee, who is a senior economist and managing director at BMO Capital Market Economics, where she's been at for well over 2 decades. Miss Jennifer is also a frequent guest speaker on Bloomberg News, and you can catch her analysis and insights on her LinkedIn, so be sure to check that out. Jennifer Lee, thank you so much for being here. It's a privilege to have this opportunity to speak with you. How are you doing?
I'm doing well. Thank you very much for having me on. I think this is a great organization to be involved with.
Thank you so much. That's very kind of you to say. So we're just going to get started then, perhaps with an introduction question, just to get allow our audiences to get to know you a little bit better.
Okay.
So thank you. So you've had obviously an extensive career in economics and in analyzing the US, Canadian, and global economy. So can you explain to us a little bit more about what interests you most about the field of economics? And can you perhaps explain to our audience as well what your responsibilities are as a senior economist and managing director?
Sure thing. Well, first of all, when you say I've had an extensive career, you make me feel like Grandma Moses. So be careful with that.
Okay.
But I will say this. This job is never ever boring, and that's I think what the cool part about it is. So if anyone is out there who is, thinking about a career in econ, I'm going to say that if you want a job that where you can just come in and sort of know and expect to do a certain list of things for during the day, and cross things off your list, this is not the job for you. And if you want like a 9 to 5 job, but when you just come in and check out at 5:01 and not think about anything past 5 o'clock, then this is definitely not the job for you. And because there's just so much going on, right, with all the economic developments out there, all the politics, the geopolitics, all the wars. So all those developments, which take place again globally, they have a big impact on financial markets in terms of the currency market, stock markets, bonds, commodities, and things are constantly changing. And I always kind of joke around when I say, as an example, North Korea is not going to take a break from firing off one of its long-term missiles or long-run missiles because it's a Saturday or because it's a long weekend. They're not going to stop because of that. So it's really a 24/7 kind of job, and that's just what I love about it because it's not boring. And the challenge I think is just staying on top of everything. You can't be an expert on everything, although sometimes people assume that we are, but that's definitely not the case. But just knowing what's out there, and so that in many ways is sort of like our job, trying to figure out all these moving parts, determining what they mean for financial markets, for our calls on policy rates, on the economy, on currencies, and helping our clients sort of navigate through it all, and sort of helping them sort of interpret what it means for their businesses and how it could impact them. So those clients could be either like institutional clients or commercial or corporate or retail clients. It could be internally within our own organization, like our bank executives. We have to talk to them about all this stuff, and it could be the media, just getting our views out there. So a lot of this, again, is just figuring out what is going on and what it means for our calls and what it means for the global economy.
Great, thanks for sharing. That's pretty fascinating to hear from an insider then what this job sort of entails. So you're a very active role, not one you can just take very lightly, and it sounds from you very constant, and you always have to be on your feet with economics.
Absolutely. Yeah, absolutely.
Thank you. So for our first question then, perhaps is your projection for the growth forecast of both the Canadian and US economy as we approach the end of this year and head into 2025?
Okay, so once again, like lots of moving parts, especially now with the upcoming U.S. election just days away, and it sounds like it's going to be a very, very tight race, and we're probably not going to know the full result of the evening of November 5th. But as it stands, like what was that phrase I learned? Ceteris paribus, right? Do you remember that? So I'm just going to talk about it from a global perspective right now. Just globally speaking, it has been a very resilient economy, again, broadly speaking. And it seems like even though we've had, since the pandemic, we've had high interest rates, we've had high inflation, we've had trade wars, we've had regular wars, and it seems like we're still it's almost like we're numb to it all because we've managed to hold up fairly well. So we're looking at roughly 3% growth again, globally, which is not a recession. It's sort of hard to define exactly what a recession is for the world. So we sort of estimate it to be roughly in the low twos, like 2% or so growth would be considered a recession. So we're roughly around 3%, like in the lowest threes, which is, again, far from recession, but it's not exactly something I'd be screaming from the rooftops over, because when you look at our average growth rate since the pandemic or before the pandemic, like in the 2 decades before the pandemic, it was like something in the 4% range. So 3% isn't great, but it is certainly better than, again, a recession. Lots of influencing factors out there that could have a say on how the global economy fares. You've got China is one of the biggest ones. Whether or not they're going to make their growth target remains to be seen. But they've got a lot of issues right now that they're dealing with. Even just on the demographic side, whether you have birth rates at a record low, a death rate at the highest since 1974. They just raised the retirement age as an example. So they're really struggling still. With Europe, they're surrounded by wars, in the Black Sea, in the Red Sea. They've got a lot of political issues right now, so it's hard to push any policies through. And of course, all the energy issues, and you've got Germany especially trying to make that very difficult and expensive transition to EV production. And so Germany is having a lot of problems right now. So a lot of issues, I think, on the most part, that different part of the world, like in Europe and in China. So I think all the strength, I think, is just basically right here in North America.
That's great. So do you believe then that the US and Canadian economies will be really resilient heading into 2025, despite all these global factors that are somewhat out of our control?
US would be the one I would be describing as resilient. Canada's not as much. And for the US, we've actually been, surprised with how strong and resilient it has been. Even after all these rate hikes that we've seen, like 525 basis points of rate hikes by the Federal Reserve over the past few years, the economy still continues to grow, and it's thanks to pandemic savings. When everyone was stuck at home working, they're ordering a lot of stuff, so that has sort of helped move the economy forward. The U.S. is also a big net oil exporter now, so we are not, or they are not, as susceptible to all the ups and downs of oil prices. Their mortgage market, they have 30-year mortgages. We don't have that up here, so they are less susceptible as well to all the ups and downs of interest rates. And certainly government spending, like the Inflation Reduction Act, the Chips and Sciences Act, bringing all this production and manufacturing onshore into the U.S. has certainly helped boost the U.S. economy. And so far, we only have second quarter growth numbers so far, but so far it's been very solid. What we're seeing as of since then, like in the third quarter and into Q4, everything looks pretty steady as well. You also had the Federal Reserve cut rates 50 basis points in mid-September, and that's certainly going to help the economy as well, sort of buffer it. So we've got this soft landing story that I think is very much in play. Now in Canada, less enthusiastic. We are a lot more susceptible to higher interest rates, especially for the consumer side, especially given that anyone with a mortgage, you basically have a mortgage, your term is either short-term fixed, or it's variable. So everyone's been hit pretty hard by all the high interest rates. So I think the Canadian economy is a lot more, again, weaker than what we're seeing in the US, just on a year-over-year basis, as an example. In the second quarter, Canadian GDP was up 0.9% year over year. Compare that with population growth, which is 3% year over year. And in the US, when you're looking at US GDP, it's up 3% year over year. So we are certainly lagging a lot. So we only have just over 1% growth penciled in for this year, but we're expecting growth to come back, hopefully next year, thanks to the Bank of Canada's rate cuts. So there will be a recovery, but just not as much as what we're going to probably see in the US.
Yeah, of course. So I guess we're hoping then that as I believe the Bank of Canada cut rates by 50 basis points,
Right.
that'll hope to stimulate the Canadian economy then heading into 2025.
Correct. Yes.
Okay, that's great. So let's hope then that the Canadian economy will be able to follow our neighbors in the US then. So I know you touched upon this a little bit while you're describing some of the global economic factors at plays, such as the wars or the demographic shifts, or even China. But what other inflationary risk factors do you believe may influence inflation going forward? And how do you see these risk factors factoring into further central banks' rate decisions going forward, as inflation is still, it's obviously calmed down a lot, but as I believe I've heard you mention previously, that's still something you want to keep an eye on.
Oh, for sure, and you're absolutely right. We're not seeing decades high inflation anymore, like 8-9%. That has come down thankfully, but it's just, I think, far too soon to call an all clear. I don't think any central banker is ever going to say that, our job is done, drop the mic and walk away, right? No one's going to say that because there's still a lot of uncertainty out there. And we just need to take a step back. We had, again, 525 basis points of rate hikes in the US, 475 basis points here in Canada. So all of those rate hikes will have had a hand in slowing the economic growth down and helping bring down inflation. That's good. We had headline inflation, we had goods inflation that was soaring during the pandemic, again, because everyone was working from home. Everyone was buying all this stuff. You couldn't find enough ships and containers to ship all this stuff over here. So that's what sent inflation through the roof. Now that's all come down. So that's back to normal now. But now we've got services inflation because so now everyone was free to walk, to roam around the country. So there's a lot of experiences that people were spending on, like concerts and travel and cruises and all that sort of stuff. So that has sent services inflation higher. Now that's come down as well. It's still a little bit on the sticky side, but broadly speaking, it's come down enough for the Federal Reserve, and I'm going to use the words that Fed Chair Powell uses all the time. It's giving him the comfort and the confidence to start cutting rates, which is why the Fed was able to cut rates 50 basis points in mid-September. So that is a good thing. Again, just the fact that they've come down way off their highs. Still a little bit of stickiness on the services side, which is what different central bankers are looking at right now. But I think as you mentioned, there are risks out there. And there are risks. These risks are the ones that I think that, that the Fed chair or the Bank of Canada governor, that they cannot control mainly with monetary policy. And I'm thinking of things like climate change. All the crazy weather, has had an impact on food prices, and that could actually push prices higher. All the wars, all the geopolitics. So this is why you have to keep an eye on, the Red Sea, the South China Sea, the Black Sea. Those wars could have an impact on energy prices and just goods prices in general, just in terms of freight costs. And I mentioned climate, and there's also wage stickiness. Labor markets are not as tight as they once were, which is a good thing, but there's still some issues there that, we haven't seen a lot of huge deterioration in the job market, which is a good thing. At the same time, it could keep wages a little stickier. So those are some of the risks out there, I think, for inflation. So that's why it's way too early, I think, to call an all clear on inflation.
That's fascinating. So all of these risks that you've mentioned, I was also just thinking about another risk. I wasn't sure how applicable this may be. You obviously know better than I do. But I've recently just heard news of the federal deficit in the US, especially, but also in Canada, reaching record highs. And do you see this potentially being an inflationary risk factor going forward as well?
That is definitely a risk. And we've been talking about it for I don't know how many years now. But, and I will always say this, as long as there is a buyer out there for US treasuries, that will keep it in play for now. But no one's really calling anyone, no one's putting anyone's feet to the flames right now on in terms of public spending or financing the deficit and pushing the debt higher. And it's kind of challenging, I think, to figure out how, especially in the US, where they're going to cut back, and they will have to eventually cut back, because right now, both candidates, both of their policies are threatening to add a lot, like trillions of dollars to the deficit. But again, going forward, when you've got people aging, so you have to spend a lot more money on healthcare. This whole move to greener pastures, like literally, like it's almost, you want climate change, you want to, lower or cut our carbon footprint. So there's going to be a lot more investment in green technology. So you have to spend there. And of course, with all these wars and all these geopolitics, kicking around the world, there's going to be a lot more spending on defense. So it's going to be very hard to figure out exactly where you're going to be cutting your spending from. But at some point, it's going to come home to roost.
Okay, and the Federal Reserve or even any central bank can only take, I guess, this data as it comes, right? So even though we sort of like have this, I guess, future data that we're perhaps expecting all these other risks. You believe they can only take it as they come in the present moment.
Yes, I mean they're trying to keep right now. Their mandate is to have cooler inflation and have and have a pretty strong job market, and inflation has come down, so that's great. So right now they're just focusing on balancing the job market, and that's really all they can do with monetary policy. All the other stuff is more coming from the government side, from the fiscal side, which they tend to not get too involved in because it's two very different animals.
Great, thank you. So I suppose we're just moving on a little bit now. You touched upon this already a little bit in answering the
Mhm.
previous question. But do you believe that overall, has the U.S. achieved this soft landing? And what do you think the Fed and the U.S. government need to do going forward to sort of maintain this sustainable economic growth?
Okay, that's a tough question. Okay, so soft landing, I'm going to say yes so far. And I always say so far, I always qualify because things can change very quickly. Data can be revised and show something completely different than it's happened before. But as of now, it looks like the whole soft landing narrative is coming into play, because we're still seeing the economy grow. We're still seeing people spending. We just got consumer confidence numbers, and they're the highest since the start of the year. Again, in the job market, like especially in the US, we've got a just 4.1% unemployment rate, which is up from the lows for sure, but it's still historically very, very low. And that's still a very healthy rate. So as long as we continue to see that, we're still seeing a decent rally in the job in the stock market as well. But as long as we continue to see relatively low jobless numbers, as long as you continue to see people spending, businesses investing, and just overall GDP growth on a quarter-to-quarter basis, I think that whole soft landing, I think the whole soft landing story is still very much in play. And plus, inflation is off the highs; that's cooling as well, so it's a good thing. So far, again, it seems like we've got that soft landing that everyone's been wishing for.
Great. So do you believe that the U.S. Economy will be able to continue this going forward?
Well, we'll have to see. So I forgot. Yeah, this is one thing you mentioned about what the Fed and what the governments can do. So the Federal Reserve can sort of keep tampering or keep playing with the interest rate. Right now, they're lowering it just to make sure that inflation is coming down. But just because right now, I think right now rates are at too much of a restrictive level. But once they see things sort of bottoming out and picking up again, they might start tweaking rates higher. So it's very difficult to find that balance. But that's their job, is to make sure that they have moderate inflation, steady job growth, in order for the economy to continue going. And that's all they can do. There are going to be mistakes along the way, but that's just the way it goes, right? No one can see into the future very clearly, like with complete clarity. In terms of the government, government is supposed to do is just to make sure that different pockets of the economy are continuing to grow as well. Like when you're during rough times, if there's a segment in the economy that needs money or that needs support, they will support it. And once they are finished with it, and once that pocket of the economy continues to starts to grow again, they should be able to withdraw that support and put that money elsewhere. But as we know, when you give a certain pocket of the economy funds, and you can't exactly take it away because voters are not going to like that either, right? So unfortunately, there's like a political angle as well there too. So you can't just do the right thing, because everyone has a different view of what the right thing is. So, but again, they're supposed to right the ship and make sure the economy as well, like the places that need it are going to get support. Places that don't need it or don't need as much support. But again, that's a very political situation to be in, and not an easy job either. But if everyone is supposed to do what they're supposed to do, then we should continue to see this moving forward. But it's never going to be that way.
Right. And so the consumer, I guess, will also be a very important factor with the US economy going forward. And perhaps just this last question as we begin to wrap up. Do you believe that the consumer you've mentioned has been very strong thus far? Will they be able to maintain this their spending and this growth going forward?
So they are not spending like crazy, which is a good thing. They actually have savings built up, and this is why I always think I don't always want to see like super strong consumer spending growth, because that could also start overheating the overall economy. So as long as we see steady-ish growth that is in spending, that is supported by steady-ish income gains, like right now we've had about 0.4, 0.5% monthly gains in wages and salaries. They're not spending at all. and they're actually putting some aside for a rainy day, which is always a good thing. So right now there's about like a 5% or so saving rate, which is a good thing again, because it shows that the balance sheets are pretty healthy. They've worked down their debt, so they don't have to spend everything all at once. And when they want to, they can. They can spend a little bit more. If they want to hold back, they can put some aside for a rainy day. Because what you want ultimately, because the U.S. consumer is the backbone of the overall economy, they make up like 75% of the whole U.S. economy. As long as they have savings to fall back on, some sort of buffer, that's always a good thing. So I think as long as they continue to keep some aside for a rainy day, continue to keep a little bit of savings in underneath their mattress, then I think that is a good thing, and that will help keep them in better shape going forward.
Well, that's very encouraging to hear then. So thank you for sharing all of that, Miss Lee. I hope, or Jennifer, I hope that was very indeed insightful for our audience as well to learn more about, I guess, where our current Canadian, US, and global economy stands at this present moment, and what they may look out for going forward. So thank you for sharing. And that just about wraps up all of our questions. So thank you very much for your time today. We really appreciate you being here with us and providing all of your insights on how you believe the economy will go, how the economy is doing right now, and how it will go going forward. So we're sure the audience has learned a lot from your insights as well. And I guess that just about wraps it up. Thank you very much for sharing. And it was a privilege to have you on here with us.
Thank you very much. The honor was mine. Thank you.